Hey there, everyone. Happy Wednesday, April 16th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny, clear, gently, comfortably cool Redmond, Washington. Hope you're all doing well, hanging in there wherever you're at, as we digest what I would loosely describe as another distribution day for risk assets here. We're back to what has become somewhat of a familiar story here in 2025, particularly after the February market peak. And in some cases, going into that peak, where some of the growth sectors struggling, value sectors hanging in there, defense over offense, and value over growth. You're going to see the three FANG sectors at the bottom of the leaderboard today, including names like NVIDIA really taking on the chin. Again, there's a lot of optimism coming off of those April lows. I don't blame you if you're optimistic or have been optimistic based on that bounce. I'm definitely more in the I don't feel like this is over camp, and hopefully through the course of the episodes we share some of the evidence that we're using to sort of gauge that overall trend in the markets. Do want to let you know, latest episode of the Market Misbehavior podcast just dropped earlier today. I caught up with Vince Randazzo. Vince is the founder of a firm called ViewRight Advisors. He's had a really cool career as a technical analyst in the markets, working with a number of people. Paul Desmond at Lowry Research, who unfortunately no longer with us, but one of the greats in the technical analysis community. He co-founded the Market Technicians Association, a fantastic, well-followed, well-regarded analyst, certainly in the institutional space. Lowry Research was one of those first big independent research firms that were really successful. And Paul was really good about simplifying and focusing on breadth. And so Vince and I talked a lot about market breadth conditions going into and coming out of the February peak, what we're seeing today. He decided or sort of described how we were in the winter season and what we would need to see for a spring to emerge. And I found myself agreeing with most of the things he was saying. So make sure you check that out on my YouTube channel. Some good conversation, also on Spotify as well these days, which is pretty cool. Shall we get to the markets and look at how things played out? I was looking at cryptos earlier, and I'll tell you, to be honest with you, Bitcoin is the one that most people immediately think of when you think of cryptocurrencies. We're going to look at Ethereum a little later because, to be honest with you, Ethereum does not look good. And while Bitcoin is sort of in the okay bucket, and you can sort of see some signs of accumulation, Ether prices just consistently in a downtrend phase of lower highs and lower lows. Pretty interesting. All right, let's get to the markets today. S&P, not great. We'd had a late inning bounce, kind of like a ninth inning rally here for the S&P, but the damage was done through the course of the day, closing just above 52.75, and that's down 2.25% from Tuesday's close. The NASDAQ composite down over 3%. That's your worst performer here. The Dow down 1.7%. Mid caps and small caps all down as well. Not as bad as the S&P. So this was actually one of those days where mid caps and small caps better than large caps. We haven't seen a lot of those. The VIX pushing back higher. We've seen a lower VIX over the last week, really since last Wednesday, when the tariff policy was sort of abruptly changed again. But the VIX has remained generally above 30. So, getting lower, but still elevated. Today, we're bouncing up about 2.5 VIX points to 32.60 something, we'll call it. All right, looking elsewhere at the bond markets. Bond actually rallied today. So that's, in some ways is a good thing, because when you see stocks kind of rolling over, you would hope that bonds are rallying, I guess, is sort of, and especially now where we've not seen a lot of flows into U.S. markets. So the TLT was up about 0.5%. I grabbed a chart of the IEI, which is kind of I think it's like a 3 to 7 year duration treasury bond ETF. Looks a lot better than the TLT, but you'll see what I mean when we look at the chart. From a technical perspective, pretty compelling chart right about here. Interest rates drifting lower when you get further out in the curve. 10-year point is currently around 4.28. The 5-year point's below 4% now at 3.9%. Long bond yield around 4.75. So if there's one thing that was not sort of good, and again, I'm very much generalizing when I say something was good or bad. this is a complex system with so many different moving parts. So I'm just trying to, draw conclusions where I can, and just trying to identify relationships. Dollar's still weaker, right? So you had a weaker day for the equity markets and weaker dollar. So again, if you had a bunch of non-U.S. investors wanting to get into U.S. assets, you'd probably see the dollar strengthening here. So that's the theme that we've been, I think, one of the things we've been concerned about here in recent weeks and recent months, the weaker dollar. All right, looking at the commodity ETFs, we can see the DBC was up about 1.25%. I mean, gold continuing to just rocket to the upside. The GLD up another 3.25%. Spot gold made a new all-time high. We grabbed a chart. We're up around $3,300 an ounce on gold. I mean, that's one of those bullish charts that just keeps giving. And I tell you, when having looked at a lot of charts over 25 years or so, there's nothing better than a chart that starts to break out and show signs of strength and then just continues to go higher. And you can continue to just reflect on, all right, trend is still good. You just do a quick check. Yep, everything's good. Higher highs, higher lows, moving average is sloping up. Momentum is good. Everything's good. And it just keeps working. I mean, it reminds you of the benefits of trend following when trends actually persist the way you want them to. And gold is just one of those great examples here in the last 6 to 12 months. Super happy about that one. Silver up as well, 1.2%. Copper prices, oil prices, natural gas was the only ETF here that was actually down. Energy stocks actually were the best out of the 11 today. Looking at cryptocurrencies, I'd mentioned this. I was looking at this just real briefly, seeing how Bitcoin had kind of chopped around. We were around 86,000 midday yesterday. By yesterday's show, we were down below 84,000-ish. We got down to almost 83,000 today before rallying higher at random points during the day. But Bitcoin's currently only up about 1% from where we were at the end of the day yesterday. Ether price is actually down 0.5%. It made me think, all right, mixed results here. What's the longer term trend? And I was surprised because I don't look at the Ethereum chart as often, but a lot weaker. And I own both Bitcoin and Ethereum in long-term accounts. But you'll see how different the charts are, particularly if you follow it as we've looked at the chart of Bitcoin prices here. Looking at the 11 S&P sectors, I don't know how many on their bingo card had energy up and everything else down, but if you did, well done, because that's how things played out. The XLE was up 0.8%. REITs were basically flat for the day. I mean, 2 pennies down from yesterday's close. We'll call that an unchanged reading. And then materials and utilities down less than 1%. But the real pain in this market were those bottom 3 sectors, right? Technology down 3.5%, communication services down 2.7%, consumer discretionary down 2.5%. Those hurt because those are 3 big weighty sectors with big mega cap names at the top there. And you'll see from the market carpet, the heat map's not great. You can see a lot of red, a lot of bright red, and a lot of those big names. And the problem is just the weights in the S&P and the NASDAQ are so significant that if those stocks are struggling, it's just impossible for the benchmark to do well given that environment. So again, we can draw one day's conclusions off of one day's data, but this certainly to me feels like back to sort of the general trend of weaker growth, defense over offense that we've been talking about really a lot of the way since the February peak. All right. Let's go. Looking at breadth conditions, we can see the advancers, decliners. Let's see. The New York Composite Index, which is the top panel, 64% down, 34% up. So you're seeing more down than up. That's exaggerated when you get to the S&P 500. 87% of the S&P members down, 13% higher. So less bad in things like mid caps and small caps, but you can really see how the S&P 500 in particular, with a mix of growth and value names, but more weighted to growth, but on an equal weighted basis, sort of almost everything down, almost a 90% down day. So while there were some random things that were higher, and if you look at like the top 10 stocks, you'll find a lot of energy, right? Like Devon, Fang, what else? Apache, right? Targa Resources. I mean, this is a bunch of energy names in the top 10 with other things mixed in. But there are a lot more stocks that were down than were up. Our market trend model remains bearish on the short-term and medium-term time frame as of last Friday. Boy, days like this make me feel like that's not changing anytime soon. Let's finish off looking at the Magnificent Seven and Friends. We've got Netflix down 1.5%, Alphabet down 2% almost, and those are your best performers out of this bucket. Netflix is a bit of a concern. They have earnings tomorrow after the close, I want to say. So boy, it's the first one of these, this bucket of stocks reporting earnings so far this season. Others will be coming out over the next 2 weeks. I think a lot of eyes will be on that one. I mean, it would feel like a bright spot, sort of the canary in the coal mine kind of thing, if Netflix could have an earnings beat here, because that's not the general sense of how I think earnings are probably going to go. Netflix down, or excuse me, Nvidia down pretty big today, down 6.9%. Tesla down almost 5% today. Apple, Meta, Microsoft all down over 3.5%. So there's three big weights in the technology sector, right? Nvidia, Apple, Microsoft, those three stocks are over probably about or just over 50% of the XLK, maybe a little less, 45%, I want to say. And when they're all down this much, I mean, technology is just going to get absolutely crushed as a group. You can see in the Dow industry groups, which is what I track over here, gold miners and mining stocks like FCX are the top performing groups. Then REITs, energy. This is more of a bearish configuration type of thing. Shout out to Matt watching on YouTube. That's actually the first time, I think, where I've gotten like a live tip, the super chat during the broadcast. Thanks so much for that. That's really thoughtful. I appreciate it. I'm glad what I'm doing is of help to you. Much, much appreciated. Thanks for watching. All right, let's continue on here. Looking at the heat map, we'll see how. If you like red, again, you're going to enjoy this section of the broadcast, I'm sure, because there's a lot of it here. And particularly on some of the big areas of the market here, right? You can see technology in the upper left, Apple, Microsoft, NVIDIA. And again, these boxes are not one-to-one ratio. And what I mean is this visualization, a heat map like this. And I remember talking with the developers at Stock Charts when we were in the process of redesigning this and updating the look of it, because it had not been updated in many 10 plus years. And so going through and coming up with a new graphical experience and a new user interface. And we talked about the scaling and actually looked at the scaling of the market caps. And the reality is, if you actually scale these correctly, like Apple and Microsoft are so big, and these little names like Humana, like you can't even read them because they're like a pixel. That's how big of a difference they are. I mean, it's very exaggerated. So the weight in these big names, when they're down like this, it's weighing on the benchmark a lot more. This sort of looks like there's a lot of neutral and even some green. So how can things be that bad? You have to remember these larger boxes, the weight is even more than the size of that box would even suggest. It's way more exaggerated. And so that's the problem there. So Apple, Microsoft, NVIDIA, that's about half of the XLK. And you can see it's not great when you get below there. I mean, you had Seagate Technologies that was up a little bit, but other than that, average stock had a pretty rough day. Even some ones we highlighted even on yesterday's show, right? We talked about CrowdStrike, down a little bit, Palantir down about 6%. So these are stocks that, again, could improve from here. But again, the general sense of guilty until proven innocent, I find myself uttering that phrase more and more these days. You also see some red in consumer discretionary and in communication services. Those are the three big growth sectors. The relative performance of these sectors is continuing to struggle, and you're certainly seeing that here as well. Let's see. Energy, a lone bright spot, really. I mean, in terms of looking at a group of stocks that are actually not down today, energy is kind of it. I would still say a lot of these charts are not fantastic just yet. I did grab, I think, Marathon MPC I grabbed to look at it. Like stocks like Apache, DVN are up, but these are stocks that are coming off of new 52-week lows in the month of April. So again, these are not great charts yet. They're just not going down today, or they're bouncing up off of a fairly beaten down level. Crude oil prices were up, right? And so that's helping some of these names do a little better than average. You're seeing random other names, right? Defense up here. So you have Lockheed Martin, you have NOC, Northrop Grumman, both higher. I was interviewed earlier, by the way, for Business Insider, which I've done an interview maybe every 6 to 8 weeks with those guys. Super nice. There's a reporter, James Ferris, who does a great job of really and having a great conversation and turning it into a really well done piece. I think addressing what we talked about. I told him groceries, guns, and gold. Those are things like what looks good. I said groceries, guns, and gold. Groceries like Kroger, still in an uptrend of higher highs and higher lows. Guns like Lockheed Martin and Northrop Grumman. And what else? We've talked about Raytheon. These are charts that aren't, in some ways not awesome, but they're not bad, right? They're pretty good charts at a time when most charts look very difficult. And then gold and things like the GDX, Newmont Mining is a chart we grabbed to look at a little bit earlier. Decent charts. Just this general feel that some of these defensive sectors, some of the cyclical sectors like real estate, like materials, looking a lot less bad than some of the growthy sectors. So this was very much a growth underperformance kind of day. Again, I think a lot of investors are expecting to not see another one of these days after the low we experienced a couple weeks ago. I don't think we're done seeing days like this. And the problem is, I don't think earnings are going to be the way that we sort of get through this period. I could absolutely be proven wrong. I think earnings are going to be less good than a lot of people are expecting. That's when things can start to rotate lower a little bit more. All right, we're going to continue on. And Tony, my second tip during the show ever, I think, from the live broadcast. And I can't thank you guys enough. That's really thoughtful. I appreciate it. If what I'm doing is helpful to you and you feel compelled to do that, I won't say no, and I'll say thank you so much. I really appreciate it. It means a great deal. I do want to let you know, by the way, we have a webcast coming up next week, Wednesday, April 23rd, 1 p.m. Eastern at 10 a.m. Pacific. I'll be doing a webcast called The 4 Deadly Sins for Investors. I actually did a session at the Money Show in Las Vegas 2 months ago. I think that was in February. February feels like a long time ago, but that's when I think I was in there doing that episode or doing that session. If you were unable to make that session live, we had a lot of fun talking about 4 deadly sins, how they creep up in your process, what you can use in the technical toolkit to avoid those deadly sins going forward. Check out that event. You can sign up scanning the QR code you see on your screen, or just go to marketmisbehavior.com/April. And that'll be a free event next Wednesday, April 23rd. Just make sure you sign up. Even if you can't make it live, I will be recording the session. I'll send out the replay. And if you're on the list, I'll make sure you get the replay as soon as it's ready to go. All right, shall we look at some charts together? Let's do it. So what happened to the chart of the S&P? I mean, honestly, not a lot new. And I think if you watch the show on Monday and Tuesday of this week, one of the things we've observed is the fact that Monday and Tuesday we opened higher and then closed lower, right? And we saw that even yesterday on some earnings names where you gap higher but then trade lower. And that general theme when stocks gap up, and instead of new buyers being like, hey, it's trading higher, but it's worth even more than that. That encourages optimism, right? I think. I mean, that tells me, okay, we gapped higher, we're revaluing the stock, but people are willing to pay even more, right? That's not even, we're still, there's more demand to drive prices higher. We're seeing the opposite. We're seeing when stocks gap higher, we're seeing supply enter in the market. We're seeing sellers thrilled to cash out at S&P 5450, and that's pushing the S&P down to 5400. And so I think on individual stocks, on the markets as a whole, we're seeing that general weaker sentiment day in, day out. And so today, kind of rotating lower after the last couple of days, I mean, makes a ton of sense because it certainly seems like that's where we've been heading. We have a market that feels heavier to me. So what does this mean? I mean, for now, it certainly feels like we're continuing a very volatile but very clear pattern of lower highs and lower lows. And again, my 9-year-old son Henry watches what I do sometimes, and I often ask him, "Look, is this chart going up or down?" I just, in my mind, I think, what would Henry say about this chart? He'd say, well, it's going down, and I think he's probably right. We drew trend lines off of the highs, and I wouldn't run a trading system based on trend lines. For me, they're a visual representation of the pace of the trend, but you can see how this trend can continue at a relative consistent pace, albeit a very volatile one, and still make downside progress, which is why waiting for a break above a trend line like this can just be a great way of just avoiding noisy, crazy, uncertain periods and just waiting for a break that has meaning, a break that gets above key resistance levels. So that rally that we saw, what we've seen over the last week and a half, has not gotten back above 5,500. And until and unless I see that, I'm thinking this is more down than up. the momentum overall is pretty weak. The RSI hasn't even pushed above 50, even during this period, which tells you that there's so much distribution that even the bounces aren't enough to change the overall picture to more of a bullish, sort of frame of reference, right? That's what it looks like back here, where the RSI rarely gets below 40 and often gets above 70. That's a market in a bullish phase where investors are buying dips. This is more of a sell the rips environment where the momentum doesn't get very high because rallies are being sold and we're rotating over. And again, today just sort of feels like we're continuing that pattern lower for now. We've talked about bond prices. And again, I think bonds going up from here would at least, reflect some optimism in the US government, which needless to say, is hard to come by these days. I mean, I think a lot of people are stressing about a lot of things that we're seeing and hearing, a lot of uncertainty, certainly a lot of instability, whether or not you agree with what is being done policy-wise. The uncertainty and the instability is certainly not being reflected with optimism in stocks because the market does not like instability. We like to be able to plan ahead and sort of be able to project where things are going. And it's very difficult to do that. As a result, generally risk assets are going down as investors are sort of lowering beta, reducing their exposure to equities. So bonds going higher at least would reflect someone's buying US debt and thinking that's a good idea. The IEI is actually trending higher today. This is we usually use the TLT, which is the treasury bonds over 20 years. This is the IEI, kind of the same bond, but in a little shorter duration, like between 3 and 7 years, kind of a 5-year ETF as opposed to like a 30-year ETF. And you can see that this is actually in a pretty decent shape, right? We're above 2 upward sloping moving averages. And again, at a time when most things are not above 2 upward sloping moving averages, this kind of resonates for me. There's that scan that I've shared with you on stock charts, which I love to run, it's called moving averages proper order, right? Is the 20-day EMA above the 50-day moving average, simple moving averages, the 50-day simple moving average above the 200-day. And if that's the order, then the primary trend is basically up, right? Because the short-term trends above the medium term and the medium terms above the long term. And so in this kind of environment, look for charts in any world, right? In any sort of ETFs that are in that sort of phase that tells you something's working. And maybe that's something you want to evaluate. So kind of the middle of the yield curve on a price basis looking pretty interesting here. Gold, of course, continuing to just blow through upside targets if you have one. I'm not a big fan of making upside targets when something's in an uptrend. And that's something I learned from days at Fidelity. And I will never forget going into a portfolio manager's office and telling him we should sell something because we'd reached an upside target. And he looked at me like, he just gave me this look and said, there's no way I'm selling. It's my best performer. I'm not touching that thing until it tells me I shouldn't own it anymore. And that resonated with me so much. And I realized that when a trend is working, you want to just continue to follow that and nurture that as long as possible. Peter Lynch talked about watering the flowers in your garden. These are the flowers that you just want to nurture and keep going. So I have a decent position in gold through a couple different vehicles, mainly GLD and IAU, which are 2 like physical gold ETFs. But boy, they're doing pretty well here. Year to date, gold is up huge compared to most other things. Especially any sort of bonds, and definitely compared to most equities, you would find very few outperforming gold year to date here. So above $3,300 an ounce today. Now, is today the day when I would open a big new position? Probably not. What you have to remember is one of the benefits of the technical analysis toolkit is combining multiple timeframes. So ideally, it's a point like this, right? A long-term uptrend pulling back to a 50-day moving average, pulling back within the uptrend. So buying higher lows within an uptrend is usually a better timing approach to it. But again, we've been talking about gold for a while, and the chart's still working. Higher highs, higher lows. Talk about a chart not doing that. Ethereum, you kind of flip the chart of gold over, and you have Ethereum, and it's interesting. I mean, I feel like it's still early days about what cryptocurrencies do in disaster situations. I think it's still, to be determined. But if you were looking for Bitcoin or Ethereum to be a safe haven in this kind of environment, not the case. These things were selling off, particularly Ethereum, right? Made a peak in December, sold off into the February equity market peak, continued to sell off as stocks sold off. It's just a nice, consistent downtrend, right? Lower highs, lower lows. The momentum is weak. The RSI is consistently below 50. it's really not finding any sort of footing. So just like that, from mid-December to mid-April, 4 months, we've gone from about 4,100 to around 1,600. That is a big drop in the value of Ethereum. So, what do you look for in this situation? Well, number one, you stop making lower lows. So we start making a higher low. I always say we try to make a lower low and fail to do so, right? So instead of continuing this pattern breaks. We make a higher low. We break above the 50-day. The RSI pushes above 50 and even better above 60, which would indicate a resurgence in upside momentum. Those are the kinds of things that would help indicate an upside reversal. I also run my market trend model on charts like this as well, and I'll save you the trouble of looking at it. It's going down on all time frames at this particular moment. Offense over defense. I actually cut a YouTube video. It's not posted just yet, but I'm going to release a video here probably tomorrow morning on the RRG, the relative rotation graph, just a quick tutorial, how I'm using it, how I use it to understand rotation, what it's telling me about the markets right about now. And the first chart we looked at in the video is this chart, which is what maybe want to share with you. The ratio of offense to defense made a new low today for the year. Now, this is the XLY versus the XLP. As a reminder, this is things you want versus things you need. We kind of always need staples. Things in discretionary are often things that you want. You may not need brand new clothes, but if you have extra money lying around, maybe you go and buy nicer clothes or a nicer trip or something like that. And so this ratio is a great way of just seeing how expectations are evolving from offense to defense, and it's been favoring defense in a big way. The equal weighted version peaked out pretty much where the market did in mid-February, and from there, both of these have been trending lower. So again, if the market's recovering, I would expect this ratio to not just have a little blip, but have more of a rotation. And for now, I'm just seeing this continue to trend lower, as if it's clearly defense over offense, and stop thinking about it. All right, this is the chart we promised to show every day this week. No real update besides the fact that none of these stocks are regaining their 200-day moving average. You're probably not surprised given what happened with the major benchmarks today. But I would argue the bull case would need to see Meta, Amazon, Tesla, these kinds of names breaking above their 200-day moving average. Because until and unless they can do so, how are the S&P and the NASDAQ going to have any sort of meaningful upside? And so what you have to remember is even that, the big spike that we saw last week, like this is the big spike on Meta. We closed back above the 200-day moving average for one day. And every day after that, we've had a lower close. Meta's been down every day since that upswing last Wednesday. So this is not a market that's showing a broad recovery. This is a market telling you expectations should be muted at best. All right, let's look at a couple more individual names here. Some earnings coming out this week that I want to highlight. Abbott's one of those stocks. And again, we talked earlier, I think on yesterday's episode, the problem with companies reporting earnings, having a gap higher, but then rotating lower. And I'll show you what I mean with this particular chart, just to show you. So here's the candle chart, and you can see, right, we open here. We trade all the way above the 50-day moving average, but by the close, we're back to the lows. That's sort of a shooting star candle. You might even call this like a gravestone doji. I don't know how you'd want to label this necessarily. It's not a perfect one of those, but certainly feels like a shooting star where you open. Think about it, right? We opened here at like 128 and change. We traded all the way up above that swing high from the end of last month, but then closed all the way back below. So during the day, that initial optimism on earnings met with a bunch of selling. And so when stocks are trading lower, even on good news, that tells you where sentiment is at. And it tells you that investors are going risk off here. JB Hunt is one of those kind of bellwether names, and a name that is good because it's a trucking name in the U.S., sort of a good way of gauging the supply side of consumer companies, right? Companies that sell goods, how much of those things are being shipped around here. This stock's been in a free fall really since mid-January, and it's accelerated here in the last couple of weeks. Today on earnings, down almost 8% today. Not that JB Hunt is the most important stock in the market, but it's just one more piece of evidence telling me things aren't good. Relative strength making a new multi-year low today on this new 52-week low in price. So, again, when stocks like this show signs of bottoming, confirmed lows, bullish divergences, that's where things start to get optimistic, this kind of thing, right? Where you see lower lows on higher momentum, that's when I will start to talk about more optimism. But eek, EEK, that's the word I would use to describe that chart. Energy stocks were up the most today, and MPC is a great example of why of I think how these trends look, right? Stock was up 1.5% today, which is pretty good on a day when most things were down, but we're still kind of within this range that we've been the last couple of weeks. The RSI is still pretty low, around 40. So we're bouncing a little bit, right? And that's good. We're bouncing off of a low around 115, but we've got a lot more to go before we even make, a higher high. You're looking for like a higher low. You're looking for some sort of stability. And I actually ran my market trend model on this chart just to show you kind of what it looks like. So this is the same market trend model that I use on the S&P 500. I look at that chart first thing every day, but then occasionally I'll run it on other things. On my monthly chart review for my premium members, we go through this model with a bunch of different ETFs. It's kind of the core part of that monthly exercise, but randomly I'll run it on an individual stock. And this just shows the challenge that I think we're in from a technical perspective on energy. Even if this sector is bouncing off of the lows, besides the two big integrators, right? Like Exxon and Chevron look kind of different, but the average energy stock looks more like Marathon Petroleum in a downtrend of lower highs, lower lows. The market trend model, as I see it, bearish on all time frames. So until that changes, it's hard for me to get really excited about buying energy until there's more signs of accumulation. Progressive, another earnings name this week, a bunch of financial companies, banks earlier in the week. Now we're getting into some insurance and a lot of more regional banks. Progressive is not a bad chart. And again, it's currently above the 50 and 200-day moving average. It was a down close today, right? So we actually opened high around 280. We closed around 275. So not an end of the world day, but you're definitely seeing lower highs, lower lows. We're seeing momentum trend lower. It's outperforming because it's just not going down as much as other things. And I think that's why things like insurance companies can be interesting bets if you're just focused on doing better than the benchmarks. I think charts like this are still pretty good places to be. Is it my favorite chart of all time? It is not, but I think there's an interesting argument for something like Progressive. But again, the weaker momentum is what it concerns me about some of the stocks that are relatively strong on a price basis. Now, there are only two stocks in the S&P 500, and I showed the ticker, so I'll get rid of that. Two stocks in the S&P 500 that are up over 50% year to date. Only two out of 500-ish names. One of those is CVS. The other one's a material stock. See if you can figure that out before we get to the chart. CVS Health Corp's up about 50, I jotted it down somewhere, 55%, I think, year to date. So again, healthcare, one of the better places, certain healthcare names certainly showing relative performance. The problem I have with CVS, if anything, I don't have a problem with it going higher. I would say the momentum is pretty weak. So we have a classic bearish momentum divergence, higher highs in price, lower peaks in momentum. That usually tells me to expect a major top here at some point, or at least that we're in an exhaustion point in that rally. Did you figure out the second one? It's Newmont Mining, NEM, gold stock. A lot of that came in the last, 2 weeks coming off of a low in early April. But look at this, retesting all-time highs. Not a lot of stocks testing their all-time highs right about now, but Newmont Mining definitely getting it done. The GDX is one of those charts that is reflecting the strength in gold and spot gold for sure. The relative performance in these gold stocks is what's really encouraging to me. Again, if I can leave you with anything from the charts, remember that in this kind of environment, when names that you're familiar with, names that you probably held very happily in 2024, when they're starting to really look ugly, focus on charts with strong relative strength. Those are the names that are going to help you survive and thrive during a period of market instability. All right, can we take a question or two, and then we'll finish it off here. Let's see, Richard, thanks for watching on YouTube. With all of the chaos coming out of Washington, how can we rely on technical analysis when the sentiments overall are negative? It's a fantastic question. I appreciate it so much. So I'll tell you a couple things, right? Number one, my interview with Vince Randazzo just posted. Make sure you watch that, because I actually posed that question to him in different form, but kind of the same idea, which was why do charts matter in this environment when all this other stuff is happening? Also listen to my interview with Michael Green, because he talks about how really what you need to be following is not sentiment. You need to be following flows. How do you follow flows? How do you follow where assets are going? I would argue, and this is what I suggested, was price is probably the best way of reflecting supply and demand, right? When there's more demand than supply, prices are going to go up. When there's more supply than demand, prices are going to go down. And, stocks have supply and demand, and that might be fueled by emotion, might be fueled by sentiment. But at the end of the day, price is a great arbiter of, what the general psychology is. That's something my mentors taught me early on. Books by John Murphy and others make it clear that price reflects all known information. That's kind of the reason why we look at charts. So I would say if you want to understand where the demand is rotating, where investors are wanting to own more of something like gold, the chart is probably the best way of identifying those opportunities. And so with tools that we have like charts, the market carpet, relative rotation graphs, heat maps, I think those are great ways of just understanding what's working, what's not. And if you can generally focus on what's working and generally not own what's not working, that is something I found that creates some pretty good performance over time. Now, having said all of that, I don't think you use technical analysis in a vacuum. My shows and my content are all about charts because I feel like that's where there's a big gap for individual investors and certainly for financial advisors between all of the stuff that you hear and read, which is a lot of like macroeconomic sort of big picture strategy, fundamental thought. But I think we need to do more to understand the charts because that's what helps us manage the behavioral side, which is something that most people don't want to talk about because it's really humiliating and humbling. But I think that's pretty important. So for me, 4 pillars in my process: macroeconomic, fundamental, technical, behavioral. And hopefully we hit those last 2, technical and behavioral, pretty good. And there are a lot of places better than I am at understanding the macroeconomic environment and the fundamental environment. But I hope you can use what we talk about here to apply it there. So I would say in times of chaos and times of volatility, I don't know of anything better than charts to help you understand how the market is anticipating change, how the market is processing change, and where the market is seeing opportunities. That's how I would be. That's how I would be thinking about it. 3P Investor, thanks as always for watching. You asked, let the winners run. We are on the same page there. But what about the concept of position size? If gold reaches 10% of one's portfolio, is it not a good idea to trim a bit? Any particular equity for that matter? 100%, yeah. And I would say that is a part of investing that a lot of individuals struggle with reconciling because when something's doing well, you don't want to trim it. You want more of it, right? You want more of what's working. It's like a gambler's mentality, right? You have a hot hand, so you keep gambling more and more. You probably know how that ends, right? In the end, you're way too overexposed and you lose and you give it all back, right? And so I think that's what you want to avoid. So what happens is you need to think of it in terms of portfolio allocation, portfolio risk. You need to think about what percent of your assets you're willing to put into a particular idea. And if you own a bunch of gold, your gold bet is going to become bigger and bigger. So at some point, your entire portfolio is a play on gold, which is good as long as it's going up, but it's not going to go up forever. And then on the other side of that, that's a really painful trade to try to unwind when everyone else is trying to unwind it too. So by trimming a position as it's working, particularly as it really does well, you can allocate to other things and just, keep your exposure consistent on some of those big bets, or at least not make it an overweight. This is an issue I think a lot of investors have run into in 2025. I'm sure many of us did not do a great job trimming overexposed growth stocks, some very crowded trades in NVIDIA and Palantir and others. Great charts when they're working, but if your whole portfolio becomes those names, and again, if that's your intentional bet, then that's fine. But what happens is a lot of people don't realize how big of a bet that can become. So most brokerage platforms, any ones that I think are worth what they're doing, show you percentages. And I use Fidelity for my investing, most of it. And they do a really good job. You have columns that you can sort on, which is like percent of my exposure. And you can just see how big are these bets that I'm making. I would review that with some consistency and just make sure that your biggest bets don't become your only bets. And that's what can happen when things really start to work. And then your exposure is arguably too heavy. Folks, that'll do it for today. Cannot thank you guys enough for watching the show. Those of you tuning in live, some really great questions. We got to some of them. We didn't get to all of them. We'll put the rest into our mailbag for Friday's episode. All mailbag episode coming out on Friday. Make sure you check out my latest podcast interview with Vince Randazzo. It was really cool. He's worked with some really fantastic investors, technical analysts. So I hope you can check out his comments there. And in the meantime, have a great evening. And remember, it's always a good time to own good charts. Take care, folks.